Hello student, welcome to the next video of Business Studies class 12, and now in this video, as we are already doing financial management, so in this video we are going to discuss about the dividend decision. Means now the next decision which the finance manager has to take is regarding the dividend. Means what to do, whatever the profit is left with the company. Now the company has to decide that whether to distribute that profit as a dividend to their shareholder, or they should keep the profit with them as a retained earning. So the dividend decision is whether to distribute the earning to shareholder as dividend or to retain earning to finance long term projects of the firm. So clear? Means now the finance manager has to decide about their profit, what to do, the whatever the profit has been left, what to do of that profit. Either they should distribute that profit to their shareholder, and that distribution is known as dividend, or if the if the company they have some future planning, investment planning in some good project they are having. So what the company will do, now the company will not distribute the dividend, but now they will retain that earning so that to reinvest them in some future, in some new investment plans, so that from there they can earn more income. I hope I made it clear to you all. Now the dividend, what is dividend? It is that portion of divisible profit that is distributed to the shareholder. Means whatever the profit is distributed to the shareholder, it is known as dividend. It results in current income of the shareholder. Means this dividend, what is this dividend? Actually it is the income for the shareholder. Means when as a shareholder I am having any I am having share of any company. Okay, I suppose I have invested some money and I have purchased some share of particular company. Now whatever the profit I will get, it will be my income of the shareholder. Then reinvestment as retained earning increases the firm's future earning capacity. Means if suppose the company have some reinvestment opportunities, so what they are going to do, it as means common man also, if we think like suppose I am having say earning of 10,000 rupees per month. Okay, so what will I do? I'm not going to spend all the money. I will retain some amount of money so that for future reinvestment, if suppose I'm having some future investment possibilities I'm having from where I can earn more, so what will I do? I will retain some money, otherwise I will spend all the money. So just like that, the company, if the company is having some future earning capacities, for they are having some reinvestment opportunities, the company will retain some amount of money for future earning. So I hope I made it clear to you all what this dividend decision is all about. So in dividend decision, the company has to decide two things: either to retain the earning or to distribute the profit to the shareholders. Now there are certain factors which affect the dividend decision. Dividend decision means whether to distribute the dividend or to retain the money. So what are those factors which will affect? They are amount of earning, stability of dividend, growth opportunities, cash flow position, shareholders preference, taxation policy, contractual constraints, and access to capital market. So now let's see all the points one by one. So the first point is amount of earning. Dividend are paid out of profit, so earning of a company is very important factor in determining dividend decision. Yes, because we know that the company, whatever the profit the company is having, what they used to do, they first give the interest out of that, then they pay all the taxes, then they give the preferential, they divide the money for they keep the money for preference shareholder, and after that whatever is left over, that profit is distributed among the shareholders. Okay, so from where this amount is coming? This amount is coming from the earning of the company. So if the company is having good earning, so what the company will do, they will distribute it as a dividend, else they will retain it for their own use. Clear? Then comes your stability of dividend. Companies generally follow the policy of stable dividend. The dividend per share is not altered in case increase in earning is small or of temporary nature. So student, you know that there are two types of shareholders. One is preference and one is equity shareholder. Preference shareholders, they get fixed percentage of interest on their invested amount. An equity shareholder, whatever amount has been left over, that is distributed among all the equity shareholders. Means there is no any fixed amount of interest to be paid to equity shareholders. So the what the company used to do, they used to follow the policy of stable dividend. Okay, means every year they are going to give only 5%, 1%, 10% dividend to their shareholder. This is generally what the policy the company used to follow. Now, this dividend per share, it can be altered only when the earning of the company is good. But if the earning of the company is small or of temporary nature, then the company, what they will do, they will give the fixed percent of the fixed, then the company will give the fixed dividend to their shareholders. Means there will be no increment in that percentage. Clear? Then comes your growth opportunities. In case there are good growth prospects for the company in the future, then it will retain its earning and thus no or less dividend will be declared. Means if suppose the in case the company is having good investment opportunities for future, like suppose the company knows that in next month if they are getting some good opportunities in some project like project A, they will be getting and out, and if they are going to invest in that project A, then the profit, like suppose the company, if the company is going to invest 1 lakh rupees in project A, and company know that in next year this 1 lakh they'll be getting say 1.5 lakh, means half 50,000 profit they are having. So what the company will do, that if the company is seeing that in near future they are having some growth prospect, then the company will retain the earning, and then either no or even, or if the company is giving some dividend, then the dividend amount will be very less, it will be declared. Clear? Means if the company is having any growth opportunities, then they will retain the amount, and if no growth opportunities for future is there, then they are going to declare the dividend. Then the next point comes is your cash flow position. The payment of dividend involve outflow of cash, and thus availability of adequate cash is required for declaration of dividend. So student, cash flow means for inflow and outflow. When the company is distributing dividend, means the cash is going out. And from where the company is paying this dividend, the company is paying this dividend from the profit. Profit is cash inflow. Means if there is regular um, or adequate cash, availability of adequate cash is there with the company, then definitely the company will declare the dividend, else the company will retain the amount with them only. Shareholders' preference is the another factor which affect the dividend decision. While deciding about the dividend, the preference of the shareholder is also taken into account. Means there are different kinds of shareholders. Some who want fixed return on their investment. Some who can wait for longer period of time, but they want a good amount of interest on their investment. So the kind of shareholder also, the kind of the preference of the shareholder also is taken into account while deciding about the dividend. Then taxation policy, a company is required to pay tax on dividend declared by it. If tax on dividend is higher, company will prefer to pay less by way of dividend. Whereas if taxes rates are lower, then the company can declare more dividend. So student, as while starting this dividend decision, I have already told you whatever profit the company earned, what they used to do, they first used to pay the interest, then they pay the taxes, then whatever is left over is given to the then the fixed percentage is given to the preference shareholder, and then last whatever left over is distributed to the shareholder. Clear? Means before distributing it to the shareholder, the company has already paid tax on that. So now the income for the shareholder, it is non-taxable. I hope it is clear till here. Now what will happen, that the shareholder need not to pay any tax and the company has already paid it. So on this basis what happens, that the if the tax rate is lower, okay, please listen very carefully, if the tax rate is lower, then the company may declare higher dividend. Clear? And if the tax is more, then the company can declare less of the dividend. So this is how this taxation policy also affect the dividend decision. Now the seventh point says about the contractual constraints. Sometimes the lender may put certain restriction on the payment of dividend in future. Constraint means restriction. Okay, like suppose when uh, while giving the loan to the company, these lenders, they may put some restriction on the payment of dividend, and in such case the company should see that the payment of dividend does not violate the terms and condition of the loan agreement. Means before giving the loan to the company, there is, if suppose any agreement has been made, and if in that agreement it is written that the company is not supposed to pay any kind of dividend to their shareholder, so such kind of contractual constraint may also be kept in mind before declaring the dividend. Then the last point is access to capital market. Corporate companies and MNCs retain less profit as they have easy access to the capital market for project financing. So student, you know that some companies which are very reputed and known to all, and there are some companies, like suppose there is some XYZ company which is new for the investors, which are not known to general public. So those who are reputed company, they can easily raise fund from capital market, and so they need not to retain the money, because they know whenever they will require money, they will means launch some share, and they can raise money through capital market. But if suppose there is some new company and they or some non-reputed company, so for them it is difficult to raise funds from capital market, because when you don't know any company, the company is unknown to you, then how will you invest in that company? So such kind of companies, new company or some non-reputed company, what they need to do, they are not supposed to give all the dividend, but they are supposed to retain some amount of money for future also. So this is how access to the capital market will also affect the dividend decision. So student, this is all about the dividend decision, the factors affecting dividend decision. I hope I made it clear to you all. So student, please do like, share and subscribe the video, and in case of any doubt you can ask me through comment box. Thank you and take care.